Hey everyone, thanks for tuning into this video. In this video, we're joined with Terry Judge. He's the CEO of Core Advisors, their cost segregation company. And we're going to talk a little about Terry's background, how he got into cost seg, some questions around cost segregation studies for anybody who's wondering. We might be able to answer some of your questions today. So really, without further ado, let's just dive right in here. So, Terry, would you mind kind of giving us a little overview on your background, how you got involved in cost segregation studies, things like that?
Yeah, Tom, great to be here. Thanks for having me. I started the company, 16 years ago, so it's 2006. To be honest, the business found me. I was before this, I had a consulting company doing energy efficiency advisory on green buildings, and we were doing, we were kind of like getting into some of the new tax incentives. There's something called 179D, and that really that was interesting to me because it kind of fit into what I was doing with renewable energy. This was back before that was even a word. 16 years ago. And then all of a sudden, cost segregation. Somebody sent me something. I don't even know. I think it was a CPA that introduced me to some of this cost seg legislation. I just was so intrigued by it, and I started reading about it. I immediately picked up the phone and called my CPA and said, "Hey, what do you know about this?" And he's like, "Not much." I go, "Is it legal?" And he's like, "Yeah, it's legal." I go, "Okay, that's all I needed to know." And then from there, I started doing my own due diligence. Started talking to a lot of CPAs. I'm here from the Detroit area. I'm about half hour north of Detroit, up in here in Birmingham, Michigan. So I actually contacted a very prominent CPA. He ended up saying, "Hey, I've been reading about this. Can you meet me, for coffee?" And this is before I even incorporated, Tom. This is before I had business cards. This is before I even decided I was actually going to start a cost segregation company. He said, "I want you to meet me for coffee. I want to talk to you about this." So this is really like my first pitch. So I'm up late night printing stuff off, make sure I'm dialed in, putting together a PowerPoint. And he knew more about it than I did. I learned so much from that first meeting, but he did say, "Hey, I have a client that he owns a 2 car dealerships, and I want you to meet me tomorrow morning. We're going to go present this. I want you to, be there and present this to him." And I was petrified. No, I'm an entrepreneur. I always kind of fake it till you make it, or act as if, as they say. And we pitched him, the guy that owned I won't say any names, but the guy that, basically was the owner of the company. He said, "Well, how much does this cost?" And I had no idea. So I just shot out a number, and he says, "Well, what do you need today?" And I said, I'll just take a deposit, 50% down. It sounded reasonable. And he wrote me the check. And as they say, the rest is history, and then from there, I started hosting seminars. I ramped up rapidly because I knew this was a niche. I knew I found something. I saw just based on from those conversations, and then other conversations, talking to CPAs around town, and then started talking to people across the country. I realized fast that a lot of people weren't doing this. This wasn't available to mom and pops out there. This was only available to the big four, big CPA firm, big four accounting firms, Fortune 500 companies that were doing it at a high level. I saw just a major gap between the client, the CPA, and the IRS. And that's really how we started. From there, we started doing seminars, started writing articles, just kind of said, "Okay, I'm just going to become the authority, in this space." And, 16 years later, over 2 billion now in savings, knock on wood, very blessed. Got a great team behind me, and it's just been fun. It's been fun working with a lot of investors. And as you know, Tom, you being a CPA, you were on my show last week, and we talked the same thing. It's still, even today, 2022, how underutilized cost segregation is. Obviously it's gone mainstream. A lot of companies are utilizing it. There's been more competition in my space, obviously. It's a phenomenal service, and it has survived. Whether you're, I'm not going politics here, but any whether you're Democrat, Republican, everybody seems to love this service. There's a lot of rich Democrats and Republicans that have buildings, and they don't want this to go away. deep down.
Oh yeah, no, yeah, absolutely. Cost segregation studies is very big in the real estate space, and could save people a lot of money, especially when you have the bonus depreciation that was put in place back in 2017. So really been popular over the last number of years. I've seen the interest in it, at least as far as our firm goes on the CPA side, really increase and just continue to become more and more popular. So I guess the question I have is, what types of investors, do you, typically use cost segregation studies, and what types of investors do you kind of work with?
Yeah, I mean, it's, our rule of thumb is, anybody that's going to buy a real estate investment property, um, with over just call it $500,000 in basis. So that's the purchase price, and we back out a little slice for land. We allocate that off, and then we just use just the real estate itself. But anything from $500,000, and it could go up to a couple 100 million, and everywhere in between. So any asset class qualifies. You and I were diving deep last week on your show about short-term rentals. That is a kind of a whole new asset class in itself. Let's touch on that hopefully in the show.
Yeah.
And everything else in between: multifamily, senior living, storage, all the buzzwords that are people are investing in, all the way down to a single family, even a long-term single family hold or real estate investment, duplexes, those kinds of things. We love working with brand new people that are getting into real estate, starting to diversify, trying to maybe get out of their W-2 and become a real estate investor. We love working with all those, those types of folks coming in, and then all the way up to the sophisticated, real estate syndicators that are doing, these 30, 40, 50, $100 million projects with investors, and it's kind of layered, and it gets a little cumbersome, but all the way up to that level.
That's awesome. It's awesome to see, how cost segregation could be, applied to such a wide array of different, types of
Yes.
investors, regardless of size or, specific asset class that they're looking to target. So that's pretty awesome. You did mention short-term rentals, which has been, absolutely on fire, or at least over maybe the last 2 or 3 years, thanks to the ability to use like the short-term rental loophole. Basically, you rent your short-term rental out for 7 days or less. You can take the losses against your W-2 or other active income as long as you materially participate, which is much easier to do than, say, becoming a real estate professional, which is also very powerful. But most of the time, in order to take advantage of the real estate professional status, you need to work full time in real estate for the most part. So I guess on the do you see a lot of short-term rental investors, coming to you guys for cost segregation studies these days?
2 years ago, I would say no, like it was minimal. And then the last 24 months, Tom, as you've seen it, it's been explosive. And we're doing a lot of it, right now. And we'll see how, as we progress, I think some of the markets are getting a little bit more competitive out there for investors, but there's still ways to cash flow these things. And the big part about it, when people are looking at it from an underwriting standpoint, you have to take the bonus depreciation as a part of the underwriting, because I see that being left out all the time.
Right.
And I think that's important to bring that into play. And as you said, Tom, this is, I'm looking personally, as you and I talked last week, I've been looking personally to buy this year as a short-term rental, as the number one reason is that I can take the bonus depreciation and use it against my income, my W-2 income that my company pays me. And just in that note alone, it's very valuable for me and other people out there doing well in their businesses. It's such a huge factor to make sure that piece is factored in on the cash flow and the cash on cash.
Yeah, absolutely. And to your point, not only is the tax benefits good, from reducing other income, but short-term rentals do tend, generally speaking, to cash flow much higher than your traditional long-term rental, because you're renting them out over a shorter period of time. You're really increasing like the daily rental rate, I guess you would say, of this particular property, and using the bonus depreciation that you get through the cost segregation study effectively can really shelter that income from tax. So not only are you able to use the bonus depreciation to offset other income from other areas of your life. I guess your other income streams would be a good way to
Yeah.
put it. But can also shelter this very strong potential, depending on where you buy and stuff, income stream from the short-term rental itself. So short-term rental is definitely very, very powerful. Very powerful.
Yeah, I agree. I mean, again, like we said, like you hear, I don't, if you've listened to different podcasts and forecasters, obviously we're in a different climate. I mean, interest rates have bumped up, but there's still plenty of opportunity, to buy and to use it too. Some people forget that, it really is, you can use it for a couple weeks out of the year and bring your family down to these vacations and also, but have this powerful, real estate investment that's working on your behalf. So just got to be a little bit more, I think, maybe a little bit more conservative on the underwriting, and because the expectations when you talk to people 2-3 years ago, they're making 30, 40, 50% on their money. It's just absolutely just insanity. And now it's, you can still make, as long as 10, 15, 20% is still in the wheelhouse, obviously that's still a good investment.
Yeah, absolutely. And right now, where we are, we're recording this in June 2022. The inflation report came in from May. Looks like inflation is still, an issue. So the Fed, the Fed still wants to hike interest rates. Just something to keep in mind as well as you're going through the investment journey. Stock market down is down pretty significantly today. I think 3 to 4%, depending on what time of the day you're looking at. But kind of, we get this question, I guess, I mean, from your experience, right, on the short-term rental side, if someone purchases a property, what percentage of their, purchase price can generally be reallocated to, say, that 5 to 15 year property that is eligible for bonus depreciation?
Yeah, I mean, what we're seeing, from our company, we're typically, allocating about 30% of the purchase price into shorter lives. Therefore, you can take that in year one. Whatever you don't use, it has excess, so it'll carry forward for 20 years. So it's not like you have to, whatever you can't use, you're going to lose. So you lock in that 20-year carry forward. I mean, that's another thing that I think is worth mentioning,
Absolutely.
today, is just that you have that available. I like to call it the open checkbook against Uncle Sam. You can use it when you need it. So yeah, I would say, it depends on the property, depends on the acreage, it depends on the just the land improvements that are part of it. So every property is somewhat unique. I wouldn't say it's cookie cutter, but we see, I would say on the low end, 20 to 25%, and then on the high end, around 28 to 35%. But I would say comfortably on a typical average short-term rental out there, even multifamily as well, is around 30%, which is big.
Yeah, nice. And that's big. I mean, the way I always describe to people, if you buy $1 million property, you're getting a $300,000 deduction effectively from bonus depreciation, which can be significant, no matter
Well,
what.
that could be part of the down payment, right? I mean, if you're putting down, 20, 25%, 250 grand down on a property, if it's $1 million property, and you're going to be able to write off 250 to 300,000 in year one, you're essentially writing off your entire down payment. And that is like huge. So bonus depreciation has been an absolute game changer for investors. And we still have a run up like this. And just to mention real quick, we got bonus depreciation will be here with us 100% to the end of the year. And then it'll go down 20% each year till it phases out. And then until 2026, I believe.
Yep.
And then people say, oh my God, cost seg is going to, does that mean that cost seg goes away at the end of 2026? No, it just goes back to where it was, which was still phenomenal, which means you're going to have all your interior improvements is in a 5-year bucket. And then all your exterior land improvements will be in a 15-year bucket. Still way better than, 27 and a half years or 39 years now for short-term rentals.
Yeah, no, absolutely. Still very powerful, and still going to be a powerful strategy for sure. We get this question a lot from our clients, and we've gotten a few different answers depending on who you ask. When should you do a cost segregation study? Say I buy a property, right, and I'm going to do some extensive renovations to it. Do I get the cost segregation study done before I start the renovations or afterwards, or is there some other middle ground that how the study should go about.
Yeah, I guess somewhere in the middle of all that. No.
Right.
It depends. So if someone's gonna buy a property and they're gonna do, major renovations, let's call it major renovations, then you would probably do whatever, if it's gonna be in the same tax year, so you buy it mid-year and you're gonna finish up those renovations before you file your year-end taxes, I would say let's just wait till the renovations are done. If the renovations that if you're gonna buy the property and the renovations are gonna be maybe next year, or it's gonna be on the, you're gonna put those costs on the previous or the following tax year, then we would just do what we call the as-built. So we call that like kind of phase one. So we'll go in and we'll carve out all of the original purchase of that property and to get you that bonus depreciation in that tax year, because that's going to be most important. So it really hinges on when you're going to file, and we'll ask those questions up front. And then we'll come back if it's the second year and you've got 100 grand, let's just call it 100 grand in renovations, then we'll account for that. If you're filed for an extension, then we would want to add that back into that open tax year, so you can take advantage of the purchase and the renovation. So it really just depends. We'll do a phase one, we call it, which is the as-built. We also can monetize some of the stuff that's coming out. We call that a partial asset disposition study. And a lot of some other caustic companies out there don't really do this piece. They don't. They'll just come in and they won't account for what's being thrown in the dumpster, and that's important. So we like to if we're going to do an on-site visit, we want to make sure that we know what's being removed, so we can account for the disposition or the demolition or the pre-renovation phase of that project. So it really is just a timing window. Once we come in, we'll kind of help you navigate the expenses of the property. And we'll really look at what year, in conjunction, with you, Tom, being the CPA, we'll work in tandem with you, make sure everybody's on the same page, and we'll dial that in and make sure that we're maximizing every nickel that you guys have put, or your listeners have put into from an investment standpoint, whether it's the purchase and or the renovations. Hopefully that was a long answer for. Hopefully that. So
that answered the question. That answered the question, because that's what a lot of our clients ask that all the time, and they get confused on when to start. So I think that was the perfect answer for that. And I know also being in the cost segregation space, you also provide other services outside of just cost segregation. So would you just kind of be able to give us an overview of what other types of services your firm provides, what other types of opportunities might be out there for investors?
Yeah, I think just from a just a short-term rental perspective, the cost segregation, our premium cost segregation services, I think would be the main service. As we move into other clients that are doing more commercial, more multifamily, storage, senior living, those kinds of things. There's other services that CORE can work with you on, which would be your property tax assessment, making sure that you're paying, the least amount when that property uncaps. And there's different timing windows, there's different, valuations and certain things that how we approach it. So that's another area that's helpful. I think the other thing is, if you're buying a larger commercial building, there are some energy incentives, and on how we kicked off the call. We when I mentioned 179D, we stayed in that arena for the whole, almost pretty much the whole time that we've been in business. So it's an energy incentive. There's some other assets that you can accelerate in the first year, which are anything around energy efficiency. So LED lighting, could be insulation, doors, windows, things that you normally would have to wait. You have to capitalize over time, over the 39-year depreciation schedule. We could actually write those off. So you get up to $1.80 a square foot. So that could be another pretty advantageous. We typically look for buildings that are about 30,000 square feet and above on that one. There's another one. So, and this is more in the multifamily space. It's called 45L, and that is an energy efficiency dollar for dollar tax credit that you can qualify for. Again, if you're putting in, if you've got high efficiency heating and cooling in the property, you're putting in high efficiency appliances, insulation, windows. If it's new construction or a pretty aggressive rehab, you pretty much will qualify for the 45L, and that's $2,000 per unit. And we've done some pretty big projects that have gotten our clients, millions of dollars. So that's another thing that I think, makes us somewhat unique in that realm. So once we start looking at your property, we're going to understand the cost that went into it. And we can kind of advise to see if there's any other, options out there in terms of tax incentives that we can help you with.
Absolutely. I've seen a lot of clients. It was not a lot. That's an exaggeration. I've seen a handful of clients who do develop properties use 45L and end up saving a lot of money. So definitely something out there to check out if you are in new construction. Definitely want to learn a little bit more about that.
Yeah.
So I guess if our listeners, listeners here wanted to maybe work with core advisors, or actually, you got one more question if you don't mind before.
Yeah.
So, there's these software studies out there, desktop studies. So we know with a traditional study, like an engineer actually like comes down to the property and does the cost segregation study, or at least starts it, right? And then like there's these software studies out there now where you put a bunch of information into a software and it'll generate a study, and it's typically used on smaller properties. I guess have you seen that a lot, or kind of what's your take on that?
Here's my take on it. You pay for what you get. It's very limited. It's very diluted. I'm not up with all of them and all the companies that are there's only a few companies that offer this type of a kind of do-it-yourself software. Anytime you go down that road and you're dealing with the IRS, I just feel like all I can say is this, that the engineering approach that we use at Core, we're going to do everything for you. We're going to work directly with your CPA. We're going to provide 100% audit defense. We're going to be able to, right down to the penny, justify it. We're going to cross-reference it to the 300 court cases and IRS revenue rulings that support cost segregation. A lot of it has to do with the permanency rules. When you go inside of a building, what can you remove that doesn't cause damage? To me, I just think you pay for what you get, even for residential, short. Now, if you've got, let me just say this, if you've got maybe something under $500,000, you've got one single family rental home that you paid $180,000 or $100,000 for, $100,000 or $200,000 for, I think that's maybe the time and place for the do-it-yourself type software. You punch in a few numbers. But if you start, if you have a portfolio of real estate, you're getting over the $500,000, you've got a lot of stuff going on with your land improvements. You've got underground drainage, you've got certain things that you have to have an engineer on site. We are going to pick up so much more money. So even if our fees are, a little bit more, the return is going to be this much more documented, cross-referenced, and IRS, approved, I would say, and it's going to stand up to any IRS scrutiny. So I'll just leave it at that. Yeah.
Thank you. No, it's very, very candid take on it. Makes a lot of sense. So, if our listeners here did want to work with you, your team at Core Advisors, what would be the best way for them to kind of get in contact with you and your firm and your company?
Yeah, appreciate that. I think the best way, just Terry Judge. So my name, Terry Judge, Judge. It's TerryJudge at coreadvisors.net, just the name of the company. So coreadvisors.net. Just reach out to me. My team would be happy to respond. We have a very simple process. You fill out a few questions, and then we learn a little bit more about your property or properties. That goes into our engineering department. We'll put together a no cost, no obligation benefit analysis that'll actually, pinpoint. It's a pretty sophisticated estimating tool that we've built over years, and it has all the calculations, net present value, to do it or not to do it, bonus depreciation. It'll tell you exactly what your first year, cash savings would look like. And then from there, we can help you, get everything dialed in and work with Tom and his firm and help you, put together a real quality study. Like I said, that'll maximize your tax dollars.
All right, awesome. So we'll go ahead. We're going to drop all that information into the description of the video, and if you're listening on the podcast, where it'll be in the show notes. I think, yeah, also, before I wrap up here, just want to say, if you did not already join the Facebook group, Tax Smart Investors, you can go do that at www.facebook.com/group/Tax Smart Investors, or just search for Tax Smart Investors on Facebook, and you can find us pretty easily. That's actually how Terry and I met. Terry's in the group, so really excited about that. A lot of opportunities that can come from a Facebook group like that. So if you're not already in it, go join. And Terry, any final words before we wrap up here for today?
No, not really. I'm glad you brought that up because I was really impressed with your community. So, and in the content that you share, like I was going through there and reading the questions and how you respond, and your partner, Brandon, I was like really impressed. Man, I learned a few little nuggets just from my own personal stuff,
Thank you.
because I'm not a CPA by training, more on the engineering side. But yeah, so keep up the good work, Tom. You guys are doing a great job. You guys got a great community going. So I'm very excited to work with you guys, hopefully in the future.
Likewise, thank you. I appreciate that. All right, so that's it for today, and we'll catch you on the next episode.
All right.